The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, and welcome to this trend trading workshop from pipsmatter.com. I'm going to be speaking about quite a few things here today. There is a lot to learn when it comes to trend trading, and I can guarantee you two things that you're going to get from this workshop. One, I'm going to open up your mind, and you're going to get a lot of very good insights and ideas, and obviously lessons are going to come from that for you. Two, you'll be able to find trends much easier and understand market trends much quicker. Believe me, that actually has nothing to do with successful trend trading. Now, before I begin, there are just three very important points I want to go over. The first point is trend followers are not lucky. So basically, trend traders are not lucky. What they are is they're prepared for the unexpected. There are two types of market moves that a market can make. One is normal, and second is abnormal. And I'm going to get to that in a couple of minutes, and I'm going to show you exactly what I mean by abnormal and normal market movement. So basically, as a trend follower, trend trader, or any kind of trader or investor, you need to be prepared. And what you need to be prepared for is the unexpected, because that is exactly where you can make the most money. Point number two is that trend traders take what the market offers in the moment, and they do not predict the future. I'm not here to teach you how to use magic. I'm not here to teach you how to guess what's going to happen tomorrow, or what color of car is going to drive outside your house in the next 5 minutes. I'm not going to guess whether it's going to rain in London tomorrow or not. What I'm here to do is show you how to be prepared and basically be ready for what the market is going to bring to you. And the third point is making money in the financial markets requires that you are able to live, respect, and accept volatility in the financial markets. So I'd like to welcome you to this trend trading workshop. My name is Dennis, and the first question I have for you is whether do you consider yourselves to be investors or traders? So what are you? Are you a trader or are you an investor? Now, just quickly to go over something. Most people I ask this question think of themselves as investors. What I'm going to do is explain to you the two differences. Some of you already know this, but some of you don't. If you knew that the biggest winners in the financial markets actually call themselves traders, wouldn't you want to know why? And I'm sure you would. So ironically put, well, stupidly put, is they do not invest, they trade. Investors, the difference between investors and traders is this. Investors actually put their money and capital into markets such as stocks, physical gold, real estate, and they do this under the assumption that the value will actually increase over time. Investors normally and typically succeed only in bull markets and actually lose a lot in bear markets because they buy the value of companies, and you can't, when you're investing in buying stocks, you can't trade against them because you're actually buying the value and hoping it will go up. I never heard of anybody making money from real estate that's actually losing value. I heard people buying cheap property and selling it high, but never buying a high and selling low. That's obviously absurd. So investors normally don't have a plan for when their investment value decreases. They don't have a plan because there's not much they can do. They usually hold on to their investments with hope, hoping that the value will reverse itself and go back up. The only thing that an investor can do to be sure that he'll actually make money from his investment is make an incredibly good, how can I say this, an incredibly good analysis of the specific company, real estate, or whatever else they're buying. So Warren Buffett is an investor, and he does his job excellently. That's why he's one of the richest people in the world. So that's all he can do. Once he buys stocks and they start losing money, there's two things he can do. Sit and hope that it will reverse, or sell out and lose money, which typically is one of the best options to do once the stock starts losing money. Well, but obviously depending for what reason it starts losing this. On the other hand, a trader actually has a definite plan of strategy to put capital into the market and obviously achieve one and only one goal, and that goal is called profit. Traders don't care whether they own what they own, whether they are long, whether they're short, just as long as they end up with more money than they started with. They are not investing in anything, they are trading. This is a critical distinction. A gentleman called Tom Basso, that's Tombasso, he's a lifelong trader. He said that a person is a trader whether or not he's actually trading. Some people think that they must be in and out constantly of the markets every single day, or even be scalpers to actually call themselves traders. That's very incorrect. What makes someone a trader has more to do with his or her perspective on life more than anything else. So, for example, a great trader's perspective includes the following: patience. Not many people have patience these days, but great traders, people who are actually profitable in the financial markets, have patience. Just like a lion waiting days for the right moment to kill its prey and feed itself, a trend trader has to, and typically, usually waits weeks or months for the right trade that puts the odds in his or her favor. So that's the job of a trend trader. You need patience and you need to sit down and wait. Now, to make this clear very quickly, I'm not a trend trader, nor is anybody else here. We are a mixture of day traders with trend traders. So we do trade daily, but we also look for trends. The reason we look for trends is very simple. And the reason is because that's exactly where the most money can be made. So that's a very simple reason. Now, additionally to what I was speaking about, waiting for weeks and months, and ideally, traders go short just as often as they go long. This enables you as a trader to make money in both up and down markets. And saying this brings me to one of the trading rules that I hold very dear. And the rule is this, and please pay attention to what I'm saying. Be just as willing to buy long as you are to sell short. Let the objective be to stay with the trend and make money and not be right. Now, I was just recently telling a friend of mine here how most people make mistakes with this. They open trades and they put so much emotion into it without even realizing this, that it's more important for them to actually be correct on their analysis or on their forecast than actually make money. And when they lose, they're more upset that they actually made a mistake in their forecasts than they actually lost money. And they say they'll never do it again, and they never do it again, but they do it again. So the idea is this. The idea is to make money, stay with the trend, keep making money, and not be right. That means, for example, we are a bit bearish we are very bearish on the USD tomorrow for the FOMC. That means we're going to be buying AUD versus the dollar, we're going to be buying GBP, we're going to be selling USD JPY, Euro USD we're going to be buying, gold we're going to be buying. But here's the thing, we are just as ready to do the opposite as we are to do the first initial thought. That means we are prepared to buy, we are prepared to sell. We are never 100% sure of something, because that would just simply be very foolish. I mean, we would probably make money, but we would look like fools. So the idea is to be a maximum of 80%, basically be 80% with the specific idea and 20% against it. But here's the thing that I also said to Adam recently, and that's it's the 20% that actually make you the most money, and not the 80%. The 80% keeps you in the market, keeps you going around, but it's those abnormal market moves, the 20%, that make the most money. Brexit was an abnormal market move. Not many people expected it. I mean, who would expect one of the largest European economies to leave from the EU based on one single vote? With so many people voting and so many people wanting to stay in the EU and stating so many benefits for staying in the EU, you would guess maybe Italy to leave the EU, or Greece, or Portugal, Spain, or Ireland, not England. England is in good economical shape. They don't have many reasons to leave the EU. So that was an abnormal market move. Many people lost money, and those 20% made money. So let's go. We're moving forward and I just want to go over one of the main rules that profitable traders follow is cut their losses short. You all need to adapt this towards yourselves just as much as your name is a part of you. You need to cut your losses short because, well, you can't get attached to a particular trade and hope that it will turn around. I never open a trade. I used to do this a lot before. When I started out, I would open a trade and I would hope once it's in the red, it will turn around because I was sort of correct for some reason. That's a big no-no in trading. We don't get attached to any kind of trades, and we never add hope into trading. When we come next to our trading station, the first thing I do is open the window, put my hand in my pocket, grab all the hope I have in there, and just chuck it out the window, because there is no room for hope in the financial markets. Some traders think that they have some kind of special knowledge or special gift or some kind of special feeling that they get about what's going to happen in the financial markets, and they place their trades accordingly. Now, many times, they are actually proven correct. Yes, they are proven correct. And that only reinforces those beliefs in their forecasting magical abilities. But when they are wrong, the tendency to actually stick with the actual trade is very high. After all, and I'm going to put this in brackets, they know which way the market should, and I'm putting capital letters, should go. And if they just wait a little longer, they're going to be right. This can be the most of the time extremely costly, and many people get wiped out, lose almost everything or everything just because they stuck with that trade without cutting their losses. Sometimes it's better to cut a 20% loss than take an 80% loss. So if you are wrong and you stuck, and let's say you have some positions open right now and you're sticking to the idea that the market will turn around, maybe, just maybe, it's time to cut those losses and look for a better trade. So the idea is to cut our losses short and have money left over to trade another day. This is something you must stick to regardless of what kind of trading system you're trading, whether you're scalping, whether you're day trading, regardless of what you're doing. You need to stick to a plan of cutting your losses short, keeping your losses manageable. Because if you risk too much of your capital, if you do it once, if you do it twice, chances are you're going to keep doing it again and again and again. And guess what? One day you're going to be wiped out. The simple trick is very simple. This is how simple the trick is. You need to decide how much you're willing to lose on each trade and stick to it. So, I forgot to move this here. You guys can read. Well, we already went over this. I can send you everything I've written down in an email. So I'm just going to go forward. Here it is. The simple trick is this. Decide how much money you're willing to lose on each trade and stick to it. Again, here we focus our attention on what we can really control. The idea is that control what you can control and forget about what you can't control. We cannot control how much we will win. That's one thing we can never control. But what we can control is how much we lose by simply adding stops, sticking to those stops, and closing our positions. Now, here's the best way I know how to put a stop loss. And I'm going to show it to you with this chart. I'm going to show it to you very simply. This is a daily chart. Let's move over to a hourly chart. Excuse me. So let's go to a 4-hour chart. And I'm going to say this first before I continue. We need to first determine where the stop will be. By this I mean you need to add a stop loss to an area of the market that if that area is reached will prove that you were absolutely wrong. Once you determine where that area is, for example, look at Euro USD. Let's say you were to buy Euro dollar. I'm going to go on the daily chart just to confirm. We will be buying this most likely tomorrow. So the lowest low recently is in this area. That approximately from here is about 86 pips. So what we want to do is if we were to open a position on a buy, we would forget about opening the position straight away. The first thing you need to do is determine the area. the area I determined I would be wrong is about here. Okay, this is the area that I believe I will be wrong if it's reached. The second thing we do is we use a risk management formula to determine the size of the trade based on the stop loss area. So this account has approximately 10,000. $80 is nothing. So we can even increase our stop. So basically, that's what you do. You find an area where if you open the trade and price goes all the way down to that area there, which is 110.80, I would be absolutely wrong, and my prediction would probably be incorrect. Then you determine your risk management, something about 0.5%, 0.3%, something very small, and then you add your stop loss there. Simple as that. Now, before I continue, there is something that I want to quickly explain, and that is it's in regards to motivation. You basically need to be, in order for you to succeed in this business, you need to be absolutely committed to habitual success. That means to create habits of success. This is not that easy. It takes time. Just like anything worth doing and anything you become good at, and I'm going to give you an excellent example if any of you watch football, of a football player, or I can do it with a basketball player or a scientist. Doesn't matter. Basically, simply having a trading system and trading rules alone is not going to make you hungry to succeed in this industry. And in this business, I'm telling you, you need to be starving in order to win. You need to be 100% committed to winning, because if you do not want to win, I can promise you this, if you do not have the gut inside you to win, there is a very good effing chance you will not win. Because in life, what you want, you normally get. What you think of comes around. At least that's my perspective. Committing to being successful in trading is very, very similar to committing, the same commitment needed to be, let's say, a top athlete. If you're going to be a fantastic football player, you need to keep pushing. You need to keep going, and you need to never give up. Let me give you a quick story of, let's say, Cristiano Ronaldo. The guy is a really good player. People hate him all across the world. There are lovers, there are haters around him. I admire him. I don't know him, so I don't like him, but I admire him for what the guy does. The guy is relentless in training. The guy trains more than anyone on the field. I remember hearing a story of some football. Real Madrid bought some guy, some recent football player, and the guy was so excited to come to training to prove to everyone how committed he is. He came 2 hours earlier to the training, and guess who he found there? Cristiano Ronaldo. Found him right there training before everyone else. Even though the guy is in the top of his field, he knows very well that in order to stay on top of the field, he needs to have a commitment. He needs to practice. He needs to commit towards constant and never-ending improvement. So if you want to make money in trading, you need to be something like that. You need to sit down. You need to read. You need to practice. You need to be committed. You need to have discipline. There is so much that's needed to be a successful trader. And the reason why not so many people have success when they trade is because they just come here for the quick money. And I promise you, there's no quick money in the markets. Money in the markets, you want quick? Well, it's going to leave from you quickly. It's not going to come to you quickly. You can be lucky and make a little bit quickly. Chances are you're going to lose real quick. So basically, what you need to do, well, let me go back to football. By the time you actually get to the Premier League, the best league in football, you now have what you want. And the only reason you have what you want is because you made a commitment at the beginning to be a winner. So if you're starting out right now in trading, make a commitment to yourself that you're going to be a winner, regardless of what happens. And guess what? Winners never quit, and quitters never win. And winners work their asses off. They're committed every single day. Because everyone wants the big leagues and the big money. But guess what? Not everyone is committed to making it happen with relentless drive. If you're going to chase success, the basic principles are this. The basic psychological requirements are absolutely the same for regardless of what you want to achieve in life, no matter what you do in life. You have to wake up every single day with a deep desire to be successful. And you have to be consistently focused every single day. That's what you have to be and do to be a successful trader. Now, we're moving on. Basically, we're here where the rules you will not follow don't matter. Trading rules are a very small part of successful trading. The most important aspects of successful trading are in your head, and they are three little words. One starting with C, the second one starting with C, and the last one starting with D. And they are confidence, consistency, and discipline. The rules you can't follow or won't follow will not do you any good whatsoever. There are many reasons to be confident in the rules that we give to our traders, and virtually all of our traders who follow our rules, even during losing periods, because our rules are very simple, they're efficient, and they're logical. So people follow these rules because, like I said, they're simple, they're efficient, they're logical, and most importantly, they save our asses from getting burnt. And that's what's important. Rules are meant to be followed, sometimes to be broken, and I'm going to talk about this pretty soon. But what we teach here is basically to have confidence and discipline, to constantly apply the rules that are given. This is one of the secrets to our clients' success we have. We don't have a very big client base, but the guys that are trading with us are quite successful, and the reason they're successful is because they follow, they listen. Their ears are wide open, their attention is directed towards us, and we guide them relentlessly, because if they succeed, we succeed. Very simple. So in tomorrow's live trading session, I'm going to be going over some of the trading rules, but here's a very small glimpse of it. The trading rules that we live by are: 1. Cut your losses quickly. 2. Let your winners ride as much as possible. 3. Keep trades small and manageable. 4. Follow the rules without question. And 5. Know when to break the rules. Okay, so now we're moving on. To trading. Now, before we open a trade, the most important things and the three most important things you need to look for are very simple. First, the long-term trend. Let's move over to the trading chart here, and let's go to USD JPY and look at the long-term. I know this is a little messed up here, but let's just focus on the yellow lines over here, and I'm going to make them a little bigger. This here, and this here. Okay, so this is the long-term trend. It's downward. It started around here, and it's downward. It's a very strong downtrend. Now we know where the market is going. That's the first thing we look for. The second thing we look for is the current trading pattern. Okay, trading patterns are very simple, and we're going to speak about them pretty soon. And the third thing is picking a good spot to buy or sell. So that's the third point. Those are the very simple primary components of our trading system. On the distant and pretty far away fourth place is our fundamental ideas. Our fundamental ideas are, let's say for right now, they could change tomorrow, that the Federal Reserve will be very hawkish and will not raise the interest rates. Or if it does raise the interest rates, it still will be hawkish, weak dollar across the board. But our fundamental ideas have cost us money many more times than our technical ideas. We at pipsmatter are 80% technical, 20% fundamental. Now, trading requires a skill at reading the markets and at managing your own anxieties. You see, these are two very different parts, but they're both of these things are extremely, extremely important. And both of them you can only get. Well, they can only become skills to you with time and constant improvement. You need to be just like the markets. And the markets are absolutely the same now, just exactly how they were 5 years ago, 10 years ago, 50 years ago, or 80 years ago. They are the same because they keep changing. They keep evolving and they keep improving, just like they did then. And that's exactly what you need to do now. The best advice I can give you for risk management is to allow your stops to do the job. Now, I'm moving on to risk control. Risk control has to do more with your willingness to allow your stops to do its job than anything else. And before you start trading, you need to begin, and here's the best explanation I can give you how you can begin trading. You need to begin with less than 10% of your liquid net worth, okay? Just about 10%. So if you have $10,000, you should start with about 1,000. And once you do start that, you need to risk less than 1% of your account on any single trade. Usually beginning with something like 0.5% and then compounding your winnings to make it worthwhile. So I'm going to teach you about compounding tomorrow, hopefully, and explain to you exactly how you can compound your trades. Now, the key to long-term survival and prosperity has a lot to do with risk management, and I'm very fond and very pro risk management. Now, the money management techniques incorporated into a technical trading system, and this is the first thing actually we teach over here. We teach risk management before anything else. There's lots of questions we ask you for psychological reasons, to understand what kind of a person you are, whether you are more aggressive, conservative, whether you are more of a gambler, whether you're more of a short-term trader. We talk about a lot of goals and things like this, so that way we can help you as best as we can. So basically the pipsmatter trading system works very well, and it works even better if you actually make an agreement between yourself and the market. This is what a successful trading system is. It's something you actually follow 100% of the time. And at pipsmatter, we are successful because we actually follow our system relentlessly. It's literally a part of our names, just as much as it's part of us, just as much as our names are a part of us. So this is the best advice we can give on risk management. I forgot to skip this for you. What we're moving on next is basically trend trading systems. Okay, so here we are. It's time to show you exactly how to use a trend trading system. A trend trading system is more than just a set of entry and exit rules. Trend trading is pretty much ultimately about you. If you do not have the confidence and the discipline to stick to a system, it doesn't matter how good the system is. If you cannot stick to the system, if you cannot follow the system, there's not much I can do for you. There's not much anyone can do for you. Your God can't even help you. No one can help you. So how do we develop confidence for our traders to stick to our system? Well, what we do is very simple. We literally build the system for you, with you, from the ground up. We first dig deep inside, and then we go up, because we don't like building on sand. You know, there's no stability on it. What we like to do is dig deep inside and build that skyscraper as high as we can. So we basically go over every single little part of the system. It does take a little time, but that time is going to pass anyway. But what you're actually going to gain from it, from that time you're going to invest, will be much worth to you than all the money you're going to ever earn in the financial markets or whatever else you're doing. So the first principle to trend trading is that I'm just going to go into trend trading very quickly. The first principle towards that is that the more you trade, the more you risk losing. So trend trading is about quality setups. That means you look for excellent ideas that you 100% believe in, and you take them. But you take them with little risk, with good stops, and if you're proven wrong, it doesn't matter. You look for the next one. I'm going to give examples pretty soon about all of this. Now, how much to risk on each trade has much greater effect on your equity than good entries or good exits. So your risk has much more significance on your actual balance than anything else. In short, if my stop is far away from my entry, I basically trade less lots, and vice versa. Depending on my stop loss is the first thing I look for. Like I explained, first we look for the stop loss, and then we determine how much we're going to open a trade with. This way, we're not very emotionally attached, and we know exactly where the market, if the market goes exactly to that point, we will know we were proven wrong. I've already showed you how to add a professional stop loss, and that is exactly how professionals add it. They look for areas in the market where they might be wrong. We do not trade with take profits here whatsoever. We move our stop losses into profit, and we use them as take profits. I'll explain this tomorrow better. Today we're just speaking about trend trading. Now, By doing this, we basically normalize the risk across the entire portfolio. Minimizing the drawdown is key to successful trend trading and trading in general. So that means your risk management and risk factor are the most important parts you can think of while opening a trade. Because after you open it, you can forget about that because there's not much you can do to change that risk. Now, no matter what trading system you use, you need to know what your edge is. In other words, you need to know how your system makes money. So when somebody asks you what is an edge, that means how does your system make money? In trade trading, we do not try to predict the future. What we do is we do not know, basically we do not predict the future because we do not know when the trade is actually going to start. We don't know when it's going to end, and we don't know when it starts, where it will stop. And we are comfortable with that. You need to be comfortable with that because you can't control these things. You can't control where the market's going to go. So you need to forget about that. You control what you can't control, and that is your risk. That's what you can control. So our edge does not pretty much rely on our predictive ability, not whatsoever. Our predictive ability is 2% of our system. In trend trading, we don't care about being right. We simply care about making money. Our win-loss ratio is nothing to brag about. We don't care about it. And trend traders, pretty much, believe me, trend traders who make millions and hundreds of millions a year, their actual win percentage is typically below 50%. What we do is we pretty much simply place out our trades according to our rules. When it goes against us, when the market goes against us, we quickly get out of that market with a small loss. When the market is in our favor, we let it ride and we compound it as much as we can. So you probably are asking, what is our edge? Here's our edge. Our edge lies in the fact that on average, our wins are much greater than our losses. Let me give you a quick example. Let's say I take 20 trades, and if we are winning just 40% of the time, we can expect to win 8 of those 12 trades. So if we place a stop loss at about a $100 value, we're going to lose $1,200. Now our winnings, since they're greater on average, are, let's say, 1 to 2, twice as much as our losses. That means we made 8 winning trades times 200, which is 1,600. Our clean profit is 400. Now in practice, we probably sometimes would not make each time 200. We may make 5 times 100, but once or twice we're going to hit the $1,000 mark. And that's what's most important. That's exactly where we're trying to catch on. Is the audio breaking? Yes, they are. Everything will be recorded in the video, and you'll be able to hear everything 100%. You're going to see everything there. It's going to be uploaded by tomorrow morning. So like I said, the edge is pretty simple. Win more, lose less. It doesn't matter if you're losing 10 in a row. You need to manage your risks because you can't predict where the market's going to go. You can predict what you can do with the market and when it goes there, what you can do about those things. Now we're moving into the pretty much final part of this session, and let's move to the final slider. Here it is. And this is the final slider, and this will take time. I wanted to speak as quick as possible so I get all the words out and move into the trading part. Before I begin, there are several factors that actually make trend trading difficult for most people to accept. For starters, it's not a get-rich-quick scheme whatsoever. Lots of patience is required. And that, in short, is a very, very, very short supply in our modern society. People like fast living. They like quick things. Everything is so fast, you know, whatever. I don't know how to explain this. So unfortunately, what I'm trying to explain here is there's no amount of math, no set of indicators that will actually build up your confidence, your patience, or your determination. The only way to build these essential skills is with time, with effort, and with positive and constant action. The first thing to do is to understand the markets. So let's find a few recent trends, and the best and simplest way to do that is to draw trend lines. So we have something here, and I'm going to start removing everything. We're going to start removing everything from the charts, and we'll start from scratch. So Euro JPY, this is a downtrend, so it's easy to just draw trend lines. Oops, it's very easy to draw trend lines on the market, and you'll be able to find points of entry, points of exit, and pretty much everything else. But I'm just going to continue very quickly before I do this. Before we do that, I need you to know that the market can only go three ways. And ironically, there are only three types of trends. There is the uptrend. Okay, this is an uptrend. There is a downtrend. So, uptrend. I'm going to fix the lines after. Downtrend. So I'm going to fix this and show you exactly what I mean. And then there is the sideways trend, which can be clearly seen on Euro USD and right over here. So I'll remove everything. This is a ranging market, and it's been happening since March. Yeah, somewhere there, early this year. This is a ranging market. Up, down, up, down, up, down, up, down, up, down, up, down. Now, that means that the market can only go up, it can go down, and it can move sideways, just like the three types of trends. So, let's find them, and let's show you here. It's very important to know the following. And the important things to remember when using trend lines. Perhaps people sometimes forget the basics. It takes at least two tops or two bottoms to draw a valid trend line, but it takes actually three to confirm it. So, see, we can draw them. It's sometimes easier to draw them on the upside. See, we have one, we have two, we have three. These are good confirmations to buy and sell the financial markets. And I'm just using trend lines right now. I will use other things to show you better movement later on. Okay, so the steeper the trend line you draw, the less reliable it's going to be, and the more likely it will actually break. Just like horizontal support and resistance levels, the trend lines become actually stronger the more times they're tested. And just to note something very important here, do not ever draw trend lines by actually forcing them to fit. That basically means if they do not fit right, then that's actually not a valid trend. It's something you wish it was. Basically, in all trading systems, the most powerful indications of strong and large movement in the market actually comes from chart patterns. So I'm showing you trend lines right now, and we're going to talk about chart patterns real quick. Double tops, head and shoulders, triple tops, triple bottoms, and so forth. So we're in a ranging market for GBP USD, and it will probably be staying in this range over here. As you can see this here, it will probably stay for quite some time. Perhaps tomorrow it will drop down with some, maybe the market will move it just a little down, but our idea is that the market will actually head higher tomorrow for the FOMC. Here we have an excellent trend line, and I'm just going to remove everything from this chart here and show you an excellent existing trend line. We start from the bottom, that's 1, 2, and we are on the third point right now. So what this means, this is a daily chart, okay? We only look at daily charts here, weekly charts, and sometimes 4-hourly charts to make entries. We do have something else here, and that's pretty much a triangle, okay? Here it is, okay? That means that once this is broken, we can see very rapid movements up. This will be called a breakout, okay? So, as we said, we're expecting movement tomorrow in the market, and we're expecting it on the upside. Well, basically, bearish movement for the USD. That means this goes up. And this is a big move. You can see that it's 160 pips and possibly much higher. So there is your trend line. This is a very good trend line. We have first confirmation, second confirmation, and we are now on the third. If this doesn't break, we have very good chances of a strong uptrend on the AUD. Even though the AUD has been very weak in recent times, we do see it heading upwards. And what we see is basically a cup formation. I wish I could draw this for you, but I'm going to try and do it like this. So imagine the market, and I'm going to show you this on the gold. So basically the market goes down and up, just like a cup here. I'm going to give you the best scenario. Not here. Here it is. Okay. So here it is. This is a cup formation. This is a very, 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 very bullish indication. And at the previous firm I worked in, where I was doing the analysis report, I gave out very strong gold buy indications. And as you see, I gave them somewhere here and gold's all the way up there. We expect the gold to head over 2000 in 2017, possibly by 2018 latest. So there you go. Those are pretty simple patterns. If you connect chart patterns to this, you can have very, very strong indications and significantly increase your trading scenarios. For example, look at this. One top, two top. Very good chances of a sell position, especially with these shadows up there. So you should learn candlesticks as well, and we'll have that in another session. We'll actually create some videos for everyone so you can easily find them on YouTube and will basically understand what's going to happen much easier and increase your trading skills much quicker. So the first way to spot a breakout or a change in trend is to draw trend lines. This way you can see changes in trends, and the best way to do it is on weekly and daily charts. Now, as I said, when drawing trend lines, it is best if you connect at least two tops or bottoms together. The more tops or bottoms that are connected, the stronger the trend line is. And the best example I can give you is this here. So I'm going to clean everything out again, and I'm going to move down to the daily chart. This is a weekly chart. So we're moving down to the daily chart. And I just want to show you how strong this is. As you can see, there are many tops and bottoms that are connected. We are actually on the fourth one already. We are literally at the fourth part already. So there is a lot of reasons why we believe that USD JPY will head down. Now, I need to warn you about something. Possibly tomorrow there will be, during the monetary policy announcements from Japan, I need to warn you about this, there could be an abnormal movement. Now, I said could. Market could go up, and then on the press conference could go down, and then possibly further down. Or it could just go down. So what I would advise you to do is be in wait and see mode. Be just as ready to buy as you are to sell. Even though the technical indications are indicating that the market will go down, and as you see, our trend lines, these are very powerful trend lines that we use, are giving us extreme and very powerful indications of selling. Okay? These are very strong indications to sell the market. But wait and see is always better. Or if you have the capacity to open, let's say, a small trade like this and use a very large stop, something like this, or possibly even up here, perhaps at this last area here where this shooting star is, and then you can target the 95s level. But what you would do to make this trade interesting for you, so you're not risking 370 to make 600, you would basically compound. Once the news finishes and everything goes down, you start opening more sell positions, and once you are in profit, you start moving your stop loss downwards. I'm going to show you how to do this in the live trading session tomorrow. So, how can we use trend lines to our advantage? Well, basically, when the price approaches your trend line, only two things can happen. The price could either bounce off and head back down towards your direction, or, it could either bounce off and head down into the direction, or break out and head into the other direction. There is a third scenario where it could make a fake out, which is basically it could go out of the trend line and tomorrow or after tomorrow come back in. We want to basically take advantage of both things, either a continuation in the trend, a change in the trend, or a short-term breakout. Now there's another way to spot breakouts and changes in trends, and that is to draw channels. This is a channel, okay, when we draw up and down. So that is another way to actually spot this, and it's pretty much the same and very simple. You just draw one up, one down, as you saw here, and pretty simple stuff. Now channels are very useful because you can actually spot breakouts on both directions. The third way you can actually spot a breakout is by looking for triangles, something like this. We're almost at the end of the triangle, as you can see here, and this is usually the time breakouts actually happen. They don't wait usually till the end to actually happen. We can possibly find somewhere else this actually, something like this already happened. It's going to be a bit hard, but well, something like this. As you see, we have a fake out over here, and then we have trend lines down here, and then price going up. This is something similar that you could see tomorrow. We could see price head up and then slowly begin going into a decent, strong trend. We are very bearish on the USD, especially with the tough elections that are coming out in America, with very good chances of Trump winning. That's not going to be good for the dollar. And in one of our videos, we explained how the Republicans and the Democrats have very different influences on the USD. Republicans always have a very bearish US dollar, and Democrats have a very bullish US dollar. So there are three types of triangles. There is an ascending one, there is a descending one, and there is a symmetrical one. I'm not going to be going over that now, but I'm going to be creating a workshop specifically for trend lines, triangles, and things like this. Now, our trading system is basically a set of rules. And those set of rules determine four things. There is 23 trading rules, and they determine four things. One, what instrument and why are we going to trade it? Two, when to enter a position. Three, when to exit a position. And four, what our risk is going to be. These are the only things we can control. In fact, after we open a trade or a position, there's only two things we can control. When we're going to exit the position, and two, when we're going to compound it, and if we're going to compound it. This is a very important point. Many traders think that their indicators tell them something about where the price is going, and because of that, they believe that sometimes they're actually right. And that couldn't be further from the truth. Indicators are a very dangerous tool to use. And I know many traders who trade the markets, people who lose and win money, and I'm telling you, the people who win money barely use any indicators. When trend trading actually, we know that we are wrong more than we are right. Yet we're actually still successful. And remember why we're successful? What the edge is? We're successful because of the edge. We win more than we lose, and that's essential. And I can accept the uncertainty, and what I focus on is what I know for sure that I can control. I accept the volatility, I accept the fake outs, I accept all of those things that I cannot control. But what I accept is, what I follow is the things I can control, and the things I have 100% control over. And those are the four items I just mentioned. Of those four things, by far the most influential on our equity is number 4, how much we can actually risk. Now again, I suppose that many people will think that points number 2 and 3, which is when to enter and when to exit the position, would have more impact. This is not the case when trend trading. It is the case when you're day trading and things like this, but when you're trend trading, the most important thing is your risk. So let's go over the moving averages that I have here. This here, you see the moving averages. I'm going to remove them, and I'm going to start adding them. And so if you're going to be attending tomorrow's workshop, the live trading chamber, you're going to be able to see what we're talking about. The first, they're all on close, okay, until I do not mention that they're not on close. The first one is a 20-day moving average, and it's Okay, 20-day moving average. That's white. They're all day. We don't care what they tell us on 4-hour charts, on 12-hour charts, on 8-hour charts. We only care about them on the daily charts because we're looking for 20 days. Next, 55 days, red. Again, close. Right after that, we're going on a yellow one, and that is 200 days. And this is one of the most important ones for trend trading, actually. The 200, and actually I forgot to add something. Actually, I will add that the last one. So this is one of the most important ones. These usually determine where trends are. The 200-day moving average is very strong for trend trading and usually determines where trends are. And right now, as you see, we've just bounced off it. On AUD USD, 200 moving average, we're just bouncing off it right now. And we just bounced off it over here, but tomorrow we have more indications for it to bounce. We are now moving on to the 370 moving average, 370 days. 370. And that will be light purple. The final and the longest one is the 987. That's 987 days. This is our longest term, and this is the dark purple one. Now I'm going to add one more, but it's not going to be on the close. It's going to be on the high, and it's going to be 40, and it's going to be dark yellow or bright brown. I'm going to make it dotted as well, so I don't pay attention to it. I'm not paying attention to it here. I'm only paying attention to it on the weekly chart, okay? Because this is the 40-week chart. We want it for the 40 weeks. Once we break above this, we can have a very strong trend on 40 weeks. But I'm going to speak about this one next time. So the moving averages are quite powerful. They're about to create a gold crossover here. Once the yellow one moves over the red and white one, that's going to be an extremely strong and powerful signal to buy the market. We don't do that yet. We have the trend lines indicating us buy movement. We have the moving averages indicating us buy movement. And if I would add the mathematical points of interest, they would also tell me to buy. But I'm not going to go over that today. I'm going to have to run pretty quick. I hope that this session has been interesting to you and that you've learned something. I've given you a couple of predictions here, and I'm telling you what we're going to be doing, and pretty much 90% chances we're going to be buying this. We do have existing buy positions open here. We have existing buy positions open here. Well, yes, we do actually, yes. USD JPY, we have positions here. Euro JPY, we also have sell positions here because, as you see here, we have a channel. I want you to pay attention to the white lines. We have a channel, and now we've actually broken below the channel, and we're creating a new channel. We have 1 and 2, and there's a very good chance that this will drop down to the 110 level tomorrow. I just want to leave you with 3 points, 3 very important points for trend trading. Well, trading in general. The first point is, do not try to guess when the trend will actually end. You or me or anyone else can hardly do that. Second point is, the prices make the news and not the other way. The market is going to go where it's going to go. Forget about the news. Once it happens, the news is going to tell you all about it. But the news will never tell you it's going to happen like this, and it actually happens. And the third point, and I believe the most important thing I can leave you of this workshop is, trading is not a sprint. It's a marathon. Make sure of that and stick to it and follow what I'm telling you. In tomorrow's live trading, chamber, which will begin exactly at this time, there's going to be a lot of information for you there. If you have live accounts or demo accounts, you can copy us trade. We're going to be opening very sure positions. We do not risk, as you can hear from my voice. And yeah, I really look forward to seeing you all there. I'll be able to take all questions then, tomorrow, 9 p.m. My local time. And just a second. Well, this is what we spoke about now. The 40 week The 40-week moving average is something I'm going to explain a little bit more tomorrow, and this is very important, very, very important, and you're going to be able to see plenty of things over there, plenty of things there. Tomorrow's workshop will start a little early. It does say it's going to start exactly around 5 minutes from now tomorrow, but if you can make it a little earlier, because 9:30 my local time, the information will be released. Well, basically the Fed minutes will be released. I'd like to see you there a little earlier so I can explain in depth what's going on and what you can do about it. So if you have a trading account that you're trading, regardless where you're trading, we can help you out tomorrow. I'd love to see you all there, and I will be able to talk to you all then as well. And if you have microphones, I'm going to be able to unblock your microphones, and it will be much easier to communicate. I see somebody. I see 3 questions there, but I can't open the box. Can you type in the question one more time, please? Or just put a dot or something, because then I can reopen the question box. Okay. Well, thank you too very much. Kato, thank you too very much. I would like to speak to you as well. If you can just send me your telephone number or your Skype account, and I'd like to talk to you tomorrow sometime if possible. I'm going to stop recording the session right now. You're all free to go, and I'd like to see you all tomorrow here.